Fred, you had a spectacular year fueled by this rally. What do you think is behind the gains? I mean, trading must be incredibly thin. I looked at the market cap. It's about $580 billion, but almost $400 billion of Bitcoin has been dormant for years, meaning that only about $180 billion actually trades. Is the thin liquidity behind the steep rise that we've seen?
I think what's driving the steep rise is a flight to safety. If you look at the correlation of Bitcoin, it's traditionally in the past few years been very correlated to the NASDAQ and to the S&P. We're now seeing it decorrelate from the NASDAQ and S&P and correlate much more to gold. So I think what that plays to is more of a thesis of flight to safety. With the banking crisis, many people realize that this is really what Bitcoin was born to do. It was born to be an asset where you control the keys, you hold your money, and nobody else does. And I think that's why we saw this big jump from 21 to 28 right in the middle of that banking crisis.
Where do you think Bitcoin is held? When you look at the concentrations, is the trading happening mostly here? Is a lot of it happening in China? I mean, surely it's global, but there are pockets where traditionally it's been necessary to hedge against inflation, like Argentina and parts of Africa. Is it still there?
Yes, I think what you see, if you divide the data up into kind of three phases, Europe, North America, Asia, you lately have seen that the price of Bitcoin tends to rise mostly during Asian trading hours. And then it sustains that with European hours. And then when the US, North America comes online, you tend to see some selling. So I think a lot of the buying has been family office and institutional buying out of Asia, as well as Europe. I know we certainly get contacted quite often from buyers who want to try and buy directly from miners, which we don't sell to. But there's a lot of interest in acquiring Bitcoin. As you said, it's fairly thinly traded. I think right now the market volume is about half of what it was during the kind of rush time in 22. So about $10 billion a day versus typically $20 billion a day. But I think what you're seeing is really the offshore markets primarily buying. In the U.S., we have a lot of regulatory hurdles. We saw a major shift in Washington's attitude towards crypto come this spring. And I think you're seeing some people reposition themselves. Meanwhile, in Europe, they have put together very good regulation. Asia's developing very good regulation. Dubai has positioned itself very strongly for crypto markets. So I think you're seeing the international markets adopting a set of fair and good rules for digital assets, where in the U.S., they're just trying to kill it.
Well, but Marathon Digital is based here in the U.S., Fred. So what outcome on the regulatory front do you fear most? And will that cause you to change the way you do business, maybe do it elsewhere?
Well, we've already started doing it elsewhere. We announced earlier this year a joint venture with the Sovereign Wealth Fund of UAE for what will be a 250 megawatt facility in Abu Dhabi. We're beginning to look extensively internationally. We think there's a lot of pressure on mining in the U.S. We have, at the same time, some states who have declared themselves states that are miner friendly. Arkansas, for example, their state legislature just voted on a right to mine bill, and the state of Montana also has a right to mine bill, and other states are trying to do that. But at the end of the day, the regulators in Washington, with what they've done with the banks and what we're starting to see noise about regarding energy and things like that, we believe that there's a concerted effort really against crypto in the U.S. And so we're further diversifying our efforts internationally.
Well, you brought up 2 points there, Fred. One, on the subject of what has happened with the U.S. banking system and crypto banks specifically over the course of the last month and change. The other being, joint ventures you're pursuing, the idea of an expansion in some sense, I gather. So how are you financing that expansion? Are you able to take out new loans, and from whom?
Well, at this point, we have no debt other than our convertible bond, which expires in 2026 and has a 1% coupon. So we paid off all our loans to all banks late last year and at the beginning of this year. So we sit on a lot of cash and a lot of Bitcoin. We don't sell all our Bitcoin. We hold our Bitcoin. I think today we have a little over 11,000 Bitcoin on our balance sheet. And as public companies, go in the US, I think we're the second largest holder of Bitcoin. So we have ample capital to finance our growth. We've already paid for the majority of the growth we're seeing this year. We're growing from 7 exahash at the end of last year to 23 exahash this year. That's over a tripling in capacity. And that's already mostly been paid for. So at this point, any further expansion, we have ample capital in the balance sheet to fund that. And we're very excited about the opportunities to continue to grow. We have one of the most modern and most energy efficient fleets in the world. Our average energy consumption on a per terahash basis is somewhere around 24 joules per terahash, where the general industry today is somewhere in the mid 40s. So we feel very bullish going into the halving cycle, which will happen in May of next year, which will put a lot of pressure on other miners. You know, if the price of Bitcoin doesn't move up substantially north of 40, closer to 50K by May of next year, there are going to be a lot of miners whose costs to mine a Bitcoin will essentially double. It'll take twice the effort. Meanwhile, the global hash rate has continued to grow. We're at record levels almost today. And it'll continue to grow through this year, making it even harder.
Does that give you an opportunity, Fred, to buy either competitors or their gear? Are you interested?
So, great question. The funny thing with Bitcoin mining is that when the market price goes down and people are in trouble, buying new stuff goes down too. So it's a build versus buy decision. And if people have infrastructure that is good infrastructure, meaning good data centers with good power pricing, those can be very attractive in a down market, whereas machines that may be 2 years old are not, because they're near the end of their economic life and their energy efficiency is not as attractive. Technology moves very quickly in this industry, and so it's very important to continually modernize your fleet. And I think what you're going to see now is the kind of growth of companies that have very modern fleets, Marathon, CleanSpark, others like that, whereas miners that have older fleets are now caught in this pickle of a situation where they can't borrow money, they can't tap the equity markets. So how are they going to refresh their fleets?